The next speakers will be Sven and Gregor, CIO and CEO at SG Value. SG Value is a Swiss asset management company which stands out due to their strict investment policy. They follow a deep value investment approach. They've achieved extremely good results for the very long term. They joined forces in 2011, and the team together, they've been managing those strategies with the same approach for many years. It's very outstanding how also, because they have funds focused on global equities, including emerging markets, and also focused on Japan, and they've achieved double-digit returns for the very long term in Japan, which we believe is extraordinary. And also in terms of their global strategies and all those strategies, as we've spoken before, as we've discussed before, the last years it's been extremely tough for many years focused on deep value strategies, and having achieved those solid results with such a complicated environment makes us believe that as the environment is a bit more favorable for them, they will be amongst the best companies in terms of long-term performance too, and they will stand out and they will make their clients extremely happy. So thank you for joining Sven and Gregor, and they are going to explain what they do.
Thank you. Thank you very much. Thank you so much for the nice introduction. Thanks for the opportunity. Thanks for listening to us. And so I'm Gregor Trachsel. I'm a part of SG Value Partners. Sven, the other part, sits there in the back. I prohibited him from speaking today because I'm speaking rather slowly, so I'm going to take up all the time. But he's used to that. Anyway, today we're a small shop, but we have 4 mutual funds under responsibility, 3 of which are global all-cap funds for different client constituencies. And the longest one is the Warburg Value Fund. We actually set it up, Sven and I, at Warburg at the time when we were working there in December of 2004. So in about a month or so, we're ready to pop the cork on that. So 20 years in that tough environment. We're quite proud of it. We didn't have any style drift whatsoever. For good or for bad, you can call us stubborn, but that's how we do things. And I'm trying a little bit to explain how we do it differently today. As you mentioned, Javier, we also manage a Japan-focused fund that just came about because we found so many cheap stocks in Japan. We pounded the table with our boss, and at the time we were working at Credit Suisse. He gave us the opportunity to do it in 2010. So we came into the positive mood about Abenomics in Japan. We didn't really know about it. We just saw the cheap stuff that's lying out there. So that's how sort of the philosophy that's behind our approach. So value landscape, everybody has their different cooking. Everybody does it differently. If you go into one extreme, you got to go distressed. You look at liquidation cases. You're trying to make a buck. You don't care about the quality of the business. You're just in for the workout and to make some money from that. For that, you got legal know-how to do workouts. We don't have that. So that's one extreme. The other extreme is people who do GARP, growth at a reasonable price. They like excellent businesses, but they're just willing to pay a little bit more for an asset. And so we're trying to pick out, the middle is kind of a Swiss thing. You're trying to go with what works. You look at other people, and then you sort of pick your niche over time. And we are actually we're buying companies that are merely for us going concerns. They are not outstandingly attractive on a first sight whatsoever. For us, they have to make strategic sense for the next 10 to 20 years, not more, not less, but we want to buy them at an extremely attractive price, and I'll go a little bit into that. So the charming thing about how we do it is not many things have to go right in our companies, and then you're already gonna be able to make some money, especially over a well-diversified portfolio. So deep value for me, it's all about expectations management. First of all, maybe investment performance, how we think about investment performance. We want to buy cheap, and we think a company is worth more than what the price is actually at the moment. My problem is, I don't know when it's going to happen. Tomorrow, in a year, in 10 years. I quite frankly don't know. So I'm in the deferred gratification game. I save for my retirement. I'm in deferred gratification. So logically, we think about in performance in terms of absolute returns over time. If you must deliver instant gratification, as the world today is shaped about, then you're going into the relative return game, obviously. We can't play that. We don't want to play that. Our clients don't want that we play that, because sooner or later you're going to buy the stuff that's in the index, or sooner or later you're going to do what other investment managers do. So we want to stay free of that. Now, how we go about investment selection. Briefly said, we are going to companies that have one or more readily identifiable problems. Problems that are readily on the table. I can look at them, I can judge them, and then I'll relate it to what the stock price has done. What's the stock telling me about that problem? And then I make a judgment, is it already discounted in the price, or is the majority of the problem discounted in the price? And then I'm willing to give the company time to remedy the problem or the problems over, let's say, the next 3 to 7 years. That's how we go about it. And so you can pick all the attributes you want. We go to messy, complex, misunderstood, and ignored situations. Or Bruce Greenwald calls it cheap, ugly, ignored, and all that stuff. I mean, it's really bad. It's bad attributes. So we go where it hurts, and I think so few people want to do it that there's a price to actually to be worth to do it. So in terms of portfolio management, that's very important, and those who know me know that I'm adamant about this. At the end of the day, it's all about the statistical effect over a broad portfolio. In our case, we have stocks that go through the roof to the upside, and we have stocks that tank. And I cannot control what's going up this year and next year. I'm completely dispassionate about it. But if you do it diligently over a broad portfolio, I think if you buy on the cheap and you go through your mental model and do it over and over again, you buy cheap, you think it's worth more than actually the mistakes you may make. They're gonna rescue you. So we're not about deep dive in the companies. We never visit companies. We never talk to them. In fact, when they call us up, we say, no need to talk, just do your business. And so we want to have the distance to the business to have an objective view of what's going on in the company. We have to be rigid with ourselves, not with the company. The company should run their business, and I have to understand it enough to make a judgment. So I want to know enough about the business that we don't make too many mistakes. So we take a sort of a negative selection approach to the business. And that's where we're kind of close to Ben Graham. And I'm convinced today, if Ben Graham were an investor, he'd do a quantitative screen of the universe. And in fact, even though we're bottom-up fundamental investors, case by case, if there was a screen, if there was a formula, if there was an algorithm, I'd do it. And I think about it all the time, but so far we haven't been able to do it. Our portfolio manager is an engineer by training, and we're thinking about it all the time, but he says, so far you cannot capture the mental model that we have so far in a quantitative screen. But in a way, we'd be systematic investors, but as of today, we're not yet. So just, current performance dynamics, Javier mentioned it, we really have a tough time at the moment. If you're not in mega cap or at least large cap, if you're not into something, let's say, high-tech, AI, social media related, and if you're not US or US dollar driven predominantly, you're going to have an enormously difficult time. But I think for the future, and that's the common sense in this room today, I guess, there's so much pent-up value in forgotten, ignored stocks that I think the future will look extremely promising for all of us. So, as I mentioned, there's got to be identifiable problems that we look at. So there are pockets of value that come about over time. They've come about over the last 20 years, and surprisingly, they stay very, very stable. So we go all where it's ugly. If you look at regions, we have a bunch of stocks in Europe, France and Germany. I don't have to tell you at the moment. I mean, there's just total gridlock at the moment, both economically and politically as well. Japan, not exactly the go-to place for Western investors. Is sort of an enigma. I don't really understand how they think, even in corporate terms. They have strange management practices and so forth. So I'd rather stay away. So we've always find a lot of ideas in Japan. Emerging markets, it's been a low reward place, let's say, since the commodity super cycle. It's here or there you had some pockets of things that work out, but we're waiting for the impetus for the next growth phase in economies. So there you have problems where we are regionally. Then we like to buy companies that are in the intermediary space where people don't see the end product. So they're just being regularly ignored because the people are not interested and they cannot feel it. They're not Peter Lynch style. I can go into or walk down Bahnhofstrasse and I recognize the product. So they're intermediary products there. We actually have an analytical advantage already. Then economic sensitivity, very high. People don't want cyclical stocks. And the main part of our portfolio is cyclical. So there you have an advantage if you're coming in from a cheap enough perspective. Then people don't like mature businesses. They don't grow fast. So I want a business that grows. We have businesses that grow GDP a little bit, GDP plus, top line, not much more. So there opens up for people who are willing to look at it. Business focus broad. We love conglomerates. We love holding companies because they're hidden assets that people don't look at directly. For analysts, it's difficult to cover, especially on the sell side. So opening up opportunities there. Next, capital financing needs high. Most of our businesses, they're very capital intensive. In fact, they have a big challenge ever returning their cost of capital. It sounds strange, but we're always, challenged. We own utilities, we own telecommunications companies, we own heavy machinery companies. It's very difficult to make money in our business, but that's what's people driving away from, and that's an opportunity for us to look at. Size, small, especially today, we don't have to say, people don't, if you can buy the S&P 500 and make a lot of money every year, why bother with small caps? So we're in small caps. More than 3/4 of the portfolio are mid and small caps. The ownership structure, we love family companies, and they are not attractive for activist investors, because when they call up the company and say change your management, they're going to laugh at them. It's not interesting for sell-side analysts to cover them on the brokerage side. So that again gives us opportunity. So this is systematically where we go and look, and we would like to define a screen if we could, but so far again we could not do it. And so I would defer this slide for a moment. Maybe I'll come back if I have a little more time in the end. Now, portfolio breakdown. This is our youngest fund, the Circle Fund. It's a global fund. You see how quirky and obscure the stock picking and the overall positioning is. Industrials and materials already make up half the portfolio. So highly cyclical business case that you buy when you invest with us. Well, we're fine with it. Consumer staples is more niche place. It's not the Procter and Gamble's, the Nestle's of the world. It's smaller companies where people actually don't really look at. As I said, telecommunications is a big theme, especially in Europe. I think there's going to be more and more cross-border mergers among the big telecom carriers. There's no way around it. They're creaking. They're barely surviving. And everybody, with social media and streaming and everything, they plug more and more services onto the telecommunications firms. They cannot expand their infrastructure because it's so capital intensive, and they should be able to do mergers in order to enable that capital flow. And I think the regulatory environment is going to go to the direction that you're actually going to be able to do cross-border deals in telecommunications carriers in Europe. So that's part of the deal. Anyway, if you look at the country setup, Italy, Japan, these days Germany is almost look like an emerging market, given what the state of the economy is there. So Brazil has always been a big part of the portfolio. And then, as I said, market capitalization is huge tilt towards smaller companies. If you look at some of the stocks that we own, you might know Sulzer in Switzerland and Saint-Gobain, the large French building products, glass manufacturer, and otherwise it's really quite eclectic what kind of portfolio positions we have. And just to give you a sort of an overview of what we've been doing recently in order to give you a flavor about the kind of stocks we are looking at. Actually, the value realization side, on the sell side, 3 of those stocks are takeovers or potential takeovers. Benesse, they're running crime schools in Japan, and they also have a nursing business for the elderly, so they're playing the very young and the very old in that sense. It's gone through management buyout along with a private equity investor. We made some good pop-up when the stock was taken private. Same thing, Lawson. Some of you might know it's a convenience store business in Japan. It's gone private as well. Was bought away from us. International distribution. The nice owners of Royal Mail. It's actually trying to be bought by Donny Kretinsky, the Czech investor. It's not through with the regulator in Britain yet, but they're trying to make a decision. We decided when the stock popped that we were going to sell it. ABB, you know, we owned it since it was below a franc way back. And now it's $50. You know, the story has been pretty much been playing out there. So, and Rolls-Royce is a classical example of a turnaround. You know, after the pandemic or in the middle of the pandemic, they barely survived. They had a huge multi-billion-dollar capital increase to take care of to save the business. And after that, when people decided to fly again, you know, the stock exploded. We were able to sell the company. The buys, you know, just I give you a flavor. You can look at it at your leisure. I'd say, in the interest of time, just one example. Paulfinger we bought recently. It's a neat Austrian company. They have truck and ship-mounted cranes and hydraulic. You know, equipment especially for the construction industry, Gregor, and also for the marine system.
Could you also please name two companies, Japanese companies too, because we cannot take questions from the audience because of time limitations, but if you can also.
Okay. Yeah. Sorry, Javier. Yeah, I skipped this slide, so I'm going back to Japan. Japan has been a special story. It's come out of nowhere, and it had a huge run up after Abenomics. International investors came in. So I want to be clear about what's driving Japanese businesses. It's expansive monetary policy. We're not investing in Japan because of the expansive monetary policy. It's going to end. So the companies, they have to be able to survive and not play on cheap money. So an alternative to China, you know, it's for asset allocators. We're not interested in that. We're not in Japan because of that. So that's passing. Forget about that. Momentum-driven investing, indexing, although it's now consolidating a bit, it's of no interest to us. But what's staying is companies that are really cheap. You know, I think still, you know, most Japanese companies that we own in the portfolio, they're significantly below, you know, below book value. Most businesses still don't get adequate returns on equity, but I think the structural changes that are being made by the policy makers on the one hand from a push side and from a company perspective, from a pull side, they're going to stay, and that's where we look at, and there's still plenty of opportunities in Japan that can be bought at very cheap prices. So we stay true to Japan, but you have to be there for the right reasons.
Gregor, what kind of returns, annualized returns, you think investors should expect from Japanese companies for the next 3-5 years?
Well, I cannot say about SoftBank and Nintendo and Sony and all these things because they're widely too expensive for us. And sort of the stocks that go into the AI narrative these days. So I have to take them out. Companies where we're investing, I think we're sort of shooting for 10% run rates of return. That's our aspiration. You know, it's not huge, but given that we're only investing in okay businesses and not superb business, that's good enough. We're easily on that path. I'm not saying, you know, because of my stock picking, I think the potential in Japan, even though we had this huge run up in companies there, is still being given. So you can earn double-digit rates of return over time in Japan. But it's definitely become much more selective. At one point in time, for the Warburg Value Fund, it's a global fund. We owned close to 50%. When was that? In 2012?
2011.
2011. People say, are you people crazy? In a global fund, Japan is not working. And we have taken this all the way back to around 15% now. So we had a lot of value realizations. But still, you know, the Japan fund has about 60 stocks, and they're screamingly cheap, the stocks that are in there.
Yes, extremely interesting, and also having seen so many different asset management companies in Europe, I think there are only 2 or 3 companies focused on deep value strategies on Japan, and you are one of the best ones in the Japanese market. So I think you have a very attractive niche for investors there, plus all your experience in global equities and your offering. So thank you so much for your time today.
Thanks for the opportunity.
Thank you.